Hello, folks. This is Naeem. I'm Chief Market Analyst at Evertrade. Welcome to our weekly webinar. Before we continue, I just want to make sure that you guys can hear me and you guys can see my screen. Please click or say yes if you can see me and also if you can hear me. Okay, great. So once again, welcome to our weekly webinar. We're just starting a little bit ahead of time. But let's go ahead. And in terms of introduction, let me begin with introducing myself. I work as a chief market analyst for Evertrade. Uh, I head the research department for Evertrade. I've worked in the industry for over a decade. In my previous jobs, I have worked as a hedge fund trader for Bank of New York Mellon and also with Bank of America in equity trading. Been with Evertrade for quite a long period of time, and my focus is primarily on equities, commodities, and forex. So, having said all of this, so why don't you guys introduce yourself a little and explain, perhaps maybe give me a little bit flavor of where are you guys from? So, please begin by mentioning what part of the country or what part of the world that you guys are from, because I see a lot of people have joined as always teaching our this weekly webinar. So where are you guys from? Okay, so I see people coming from India, Sweden perhaps, South Africa, again South Africa, San Antonio, Texas. Wow. Okay, and from Pakistan, again from UK. Okay, so we have Greece. Interesting. I was in Greece last year around this time. The weather was phenomenal, but sadly, this year we are all still under a lockdown. This particular lockdown, especially in the UK, we will see this lockdown relaxing to some extent by tomorrow. So hopefully, some shops will open and then we can go out and then grab some coffee and just, really, I'm really looking forward to some sort of a normality to our daily lives because things have been very, very dire over here. What about Jamaica? I see that people are from, so that there are some individuals from Jamaica as well. Is everything under a lockdown condition over in Jamaica as well? Okay. All right. Okay. All right. So, folks, so first of all, I wanted to ask you guys two important questions before we begin. Um, so please say yes if you have been trading for let's say for 1 year or so. So if you have been trading and you've been active in the market for the last year, so please do say yes. Okay, wonderful. A lot of people. All right. Okay. So now for those people who've been trading over 2 years, please do say yes. Okay, so not many people are in that category who who've been trading for over 2 years, so fairly new traders in this particular webinar. That's okay because the only reason, as always, I ask this question is because I wanted to break down things to a level to where you can really understand them. So remove the complexities in this particular webinar and then bring things really to your level so you can understand things. But obviously, I will be presuming that certain amount of knowledge with respect to trading that you guys already have, and we will build on that. Now, for the final question, if you guys have attended any of my previous webinars, please do say yes. I see some familiar names over here anyway. So, yeah, yeah, there are a few people who have attended these seminars, so that's really good because on a weekly basis, I think this really gives us a really an opportunity where we can see where those important levels are in the market and what is really driving the markets. And I think this is what the most important thing is with respect to to these webinars, because these webinars are really an opportunity for you guys. And then in this particular webinar, especially for towards the last 10 minutes, I am going to give you guys a lot more opportunity to ask questions, because in the previous webinars, obviously the time, because of the constraints, we are always constrained by time, and we don't get opportunity to allow you guys to ask so many questions. So in the last 10 minutes, I'm going to keep those last 10 minutes for you guys to ask as many questions as possible. And remember, every month we do hold this YouTube live session. Again, the information of that can be found on our social media, which I will show you guys in a bit, or how to find us on social media. But the primary purpose of that particular session is for you guys to give you guys an opportunity to ask as many questions as you can with respect to markets, or what do you think, or if you are struggling any questions with, and we can really help you with any of those questions. So before I begin any further, it is important for me to go through this slide of disclaimer and risk warnings. Anything which will be discussed in this particular video cannot be perceived as an advice. If you are seeking for one, please do consider consulting with your own financial advisors, as they will be more aware of your own financial situations. The first full disclaimer is right in front of you. Now, in order for you guys to contact us, guys, first of all, I can never stress more the importance of you guys being on Twitter. And as I have always said in all the previous webinars, and I will repeat it again, that Twitter is one of the best forms of information that you guys can really get these days. Because whether it is about corporate earnings, whether it is about macroeconomic news, or whether it is about geopolitical news, especially with Trump, you get all these particular news straight before they go anywhere, that they come on Twitter. And then these particular news, they have the ability to move the market significantly, especially the fact that Trump has really ramped up the tensions once again between the US and China. I think all those tweets from Donald Trump and from Chinese officials, they are of significant importance. And then you guys should really stay abreast of these. You guys should really understand them, and not only like see that, okay, what they have the information, but you guys should also understand and digest those news. So in order for you guys to have that access to that sort of information, the Twitter handle for myself is right here, Naeem Aslam 23, and for EverTrade it is EverTrade. So let me show you guys how you guys can really find us on our Twitter channels, right? So here we are. So this is this is my Twitter handle over here, and as you can see, there's a lot of information on a daily basis that we do post on them, whether with respect to whether you're talking about dividends, whether you're talking about markets, whether you're talking about the sell-off that has happened in the market. So all that information is right there for you guys to really understand it. And then this is the handle for EverTrade. As you can see, we are verified by Twitter. So yeah, just make sure that whenever you are trying to follow EverTrade, you see that there's a verification sign next to it. So don't go and then follow any of the fake accounts if they do exist on the market. And once again, all that information with respect to markets, everything is there. Yeah, and if you guys want to follow, and then I think it is essential for you guys to really listen to our daily commentaries. And in order for you guys to do that, you can go to YouTube and then find us under EverTrade, and then there you will see the different videos. Now, what are these videos? On a daily basis, we produce one particular article which covers the entire story for that particular day. And then that particular article is published on our website, evertrade.com. So you can go on that and then read on it. So under the education, you have to go to blog, and then you see all the articles published there. But on the YouTube channel, what I do is I break down that information in a more digestible way and in a very simple format. So by watching the video, which is about 5 to 7 minutes long, you guys will get the really that flavor about what factors are really going to move the markets on that particular day. And sometimes there's also an information which is not only valid for that particular day, but it is also valid for the upcoming week or also for the upcoming month, and so on and so forth. So this is why I think I highly recommend you guys to go and then watch these videos and then really understand what exactly is there for you guys to watch. And in addition to that, what we also have in those videos is the technical analysis, right? So every single day we pick up one particular derivative and then we perform a technical analysis on that. So for instance, today it was all about the UK GDP number, and then we've done a technical analysis on the back of that by looking at the FTSE 100 index. The number was very, very bad, right? It was a dire reading. There's no doubt about that. Nearly in 2 centuries, we haven't seen this sort of a plunge for the GDP, but it happened. And what we wanted to see it was that, okay, how the market reacted to it, or how the market is going to react in the future as well, obviously. And then we did the full analysis. Again, if you want to watch that, so do go on a daily basis on our YouTube channel, and then you will get all that information right there for you guys. All right, so let's begin. So what is on the agenda for today? So number one is we're going to discuss what kind of indices are there. Now, obviously, when we talk about indices, we have European indices, we have US indices, and we have Asian indices. So for Europe, we are talking about indices like DAX, CAC, FTSE MIB, which is the Italian index, IBEX, which is the Spanish index, and for the UK, it is your UK 100 FTSE 100 index, right? So if you want to trade the US markets, the three major indices that you may want to focus over there are S&P 500 index. This represents the more broader range of the market. Then you have the index, which is mainly focused on the tech side. That is your NASDAQ index. So if you wanted to trade, mostly the techie stocks, then it is your NASDAQ 100 index. And then you have Dow Jones 30, right? So this represents the 30 top 30 stocks, and you can trade that by trading the Dow Jones index. Now, the second important question is that why to trade indices? Why do you want to trade indices, right? The reason for you to trade indices is because obviously we are not institutions as a retail investors. We have limited amount of money. We cannot go and then start buying and selling Amazon at the same time, and then Google, and then Microsoft, and then Apple, because obviously these stocks, as you will start buying them, each one of them will require you to have more margin. Each one of them will require you to have more capital in your portfolio, and then at the same time, you are still not getting that wider exposure to the full industry. But on the other hand, when you trade NASDAQ 100, you are automatically, you have an exposure to all these major tech stocks that you wanted to trade. And then by trading that, you are trading all the top 100 NASDAQ stocks. So by using less capital, by using less margin in relative perspective, you have a bigger exposure, and then you have a wider hedge as well, because you are really diversifying your exposure against a number of different stocks. Now, when to trade indices, that is the next question, right? So in order for you, when is the best time to trade indices? Perhaps when you think that you wanted to have a wider exposure to a large number of stocks, because one would only trade a particular stock when they are absolutely sure about that particular stock, its business model, its fundamentals, and they are certain that yes, this is the particular direction this particular stock is really going to perform. And then by trading those stocks, individual stocks, what you're trying to do is then you're really trying to beat the market, because you think that those stocks have the ability to move the market, to move more in terms of the percentages as compared to the actual index. So that is why you will really trade individual stocks as opposed to indices. But obviously, when you start trading individual stocks, your exposure, you are less diversified. You have a exposure to one particular stock, and you are prone to a higher risk at the same time as well. Now, what the next one is, what is the current state of markets? Now, obviously, guys, with respect to fundamentals, we have a massive support in terms of a fiscal monetary policy, in terms of a monetary policy, right? All of that has happened. And this is what the markets has been really, looking at for the last 3 months or so, because everyone was saying that, okay, there's a huge lockdown situation going on, and how that is going to really impact. And then everyone was expecting for the markets to revisit the lows, which I will show you in a bit, the lows which were formed back on the March 23rd. But obviously, market hasn't done that. We have seen massive rally. The rally only happened because of this, because of significant stimulus and monetary policy support that we have received. Now we have gone past pretty much the earnings season. Now we are into a next phase where the global economy restarts, and then it starts to open. The economic activity will pick up, or is likely to pick up perhaps. We can see some sort of a bottom forming in terms of economic data as well, but we are still far from achieving that bottom. I think there's going to be about another month or two before we get the actual bottom in the economic data. For instance, last Friday we had the US NFP data. I think there's going to be another month or 2 months reading before we really see the bottom formed in the US NFP data. The similar situation is for the UK GDP. It came in at nearly about 6% drop for the UK GDP on a month-on-month basis, but that was only recording the first 9 days of this lockdown that we have seen over in the UK. The rest of that period is still going to be very much recorded in the upcoming month. In upcoming months GDP reading. So that is where we are looking at in terms of a bullish case. The bullish cases have started to fade to an extent. Why? Because we already have seen the fiscal monetary policy support. And yes, the Fed and then the other central banks are likely to keep the monetary policy, the dovish tone in the monetary policy, but whether we are going to see further reaction from them, it is not likely at this particular point. In terms of bearish points, I think we are likely to see more and more bankruptcies coming up in the coming weeks and in the coming months, because this is despite the fact that the economic activity will return. But despite the fact that this economic activity will return, but we are not going to reach the previous level of economic activity. It is going to take a long period of time for us to reach that previous level. And this is why the jobs which are going to be lost, or which have already lost between this period, they are going to have negative influence on the businesses, and eventually people will spend less, and that is going to have an impact on the economy, and hence it will result in less business activity, meaning more defaults perhaps in the coming months or so. Right. Now, before we move on to our defining levels and performing the analysis further, are you guys clear so far with respect to what I have discussed? Does this make sense to everyone, what we have discussed? If you are unsure, please feel free to post it. Feel free to ask questions, Okay, people saying 50%. Some saying that, yeah, important is to make profit consistently. Yeah, for sure. For sure. All right. So all good. Pretty much that's what people are saying to me. Now, let me move on to the next stage. Let's just shift the gear from here and then go to actual platform. And then I'm going to pull out the MT4 platform for us. And this platform, as always, can be downloaded from our website, evertrade.com. And now what we're going to do is we're going to perform the technical analysis with respect to different indices. as always, we will begin with a weekly time frame, and then we will shift the gear to into a lower gear, and then we will start looking at the daily time frame, right? And on in terms of moving averages, all the price actions, all the derivatives that we will be looking at, they will have the same moving averages. First of all, we will begin with the 200-week moving average. This is shown in green. Followed by that is going to be your 50-week moving average, which is in pink, and then you have 100-week moving average right over here shown in orange. Now, when we look at the FTSE 100 index, what we can see is that obviously the price is trading well below that, so there's no doubt about it. But in terms of a price action, this is how to read the price action. So this was the area after the massive gap to the downside. The price started to move to the downside, and then this is the major area of support, right? And after that, this is the second area of support where we anticipate for the price to come if the sell-off continues to the downside, right? Now, what happened was the price formed the double bottom, came into this previous area of resistance, and ever since the price started to move lower. Now, for the last week, because obviously each and every single candle over here represent a full week, what we see is in the previous week is that the price crossed below this week's low and it failed to cross above this week's high. So this particular candle was telling us, despite its green color, it was telling us that the price action is somewhat negative, right? So that was the message from here. Now, this week, what the message that we are getting from the price action so far, and given the fact that we are already midweek here, is that yes, the candle is red, but we are above the previous week's high, meaning that the price action is bullish. And the second bullish sign for this particular week's price action comes from the fact that the price hasn't price didn't go below this particular candle. In fact, the price didn't even go below this particular week's candle as well, and price just kind of touched the high of this candle. So what this week's price action is showing, despite its red color, is that things are looking positive to a larger extent, and they will remain positive as long as this week's low remain intact. So that is how to read the price action. Now, when we go into our daily time frame, the opportunity can only be if the price breaks below this 50-day moving average. Remember, the moment that we change the time frame, that these moving averages from weekly time frame changes into daily time frame. Now, obviously, as the price is above the 50-day moving average, so as long as the price stays above the this 50-day moving average, we do stand strong chance for the price to come back into this area of resistance. Now, if the price breaks below this 50-day moving average, then the chances are that the price may come into this area of resistance and area of support, and this area of support could actually provide us an opportunity to trade to the upside. But remember, once the price breaks below the 50-day moving average, what you want to do perhaps is you want to trade in the direction of the current trend, and that direction is to the downside. So perhaps a lucrative trade could be, if the price breaks below the 50-day moving average, is to look for the trade to the downside and with the target of this particular range, this particular area of support with our with a potential target, right? Now let's have a quick look at the Dow Jones. Again, from the weekly time perspective, the price is above the 200-week moving average. This is certainly a positive sign. So obviously, Dow Jones Index is more powerful than the FTSE 100 Index in terms of its strength, but it is trading below the 100 and 50-week moving average. Again, we formed sort of a double top, not exactly the double top, but the top was formed, right? And in terms of our price action, not the last week, the week before that, the price when it formed the double bottom, then the last week's price action confirmed that yes, the trading has been very much within an intraday, within an intra-week basis. Why? Because we failed to break above last week's high, but we didn't go below and significantly below than the previous week's high is a low as well. Now, as long as the price stays above the 200-week moving average for the Dow Jones Index, I think things can still look positive. But if we get a close for this particular week, which is below the 200-week moving averages, then all bets, all bullish bets could be off for the Dow Jones Index. Now, if we switch the time frame, going to a daily time frame, again the concept is very similar for here as well. Price needs to, if it breaks, and remember on the weekly time frame we are very close to its 200-week moving average. The first sign is going to come from our weekly time frame in case of Dow Jones, not from the daily time frame. If the price moves below and remains below the 200-week moving average, we are likely to see this particular price action to cross below the 50-day moving average as well. So remember that in this case, the important element is that we got to keep an eye on the 200-week moving average on the weekly time frame. Now let's go on to the next one. This is your S&P 500 index. Obviously, the index is above the 200-week and the 100-week moving average, but again, it is very similar to Dow Jones Index. Obviously, this index is stronger than the Dow Jones Index and it is stronger than the FTSE 100 index. But over here, what we are going to focus on is if the price can stay above the 100-week moving average, just like how we did it with the Dow Jones Index, where we said if the price can stay above the 200-week average. In the S&P 500 case, we're going to look at the price if it can stay above the 100-week moving average. And when we switch the time frame, again, we are going to see if the price cannot stay above the 100-week moving average on the weekly time frame, that it is likely for the price to come close to its 50-day moving average. Now, 50-day moving average under the circumstances for the S&P 500 can act as an area of support. Why? Because this is where the 200-week moving average is as well. So this is slightly different than the Dow Jones Index, because over here, we are not really looking for the trades to the downside. We are looking for an opportunity to the upside. Why? Because the price has, it's nearly challenged its 50-day moving average, and if it breaks below the 100-week moving average, then the opportunity for the long side could be potentially in around this area of support. Now, to finish off the last one, to the Nasdaq index, it is doing its own thing on the weekly time frame. The index only came close to its 200-week moving average, never closed below that, stayed above. It then crossed above the 150-week moving average, and now it is, talking about, we are talking about really if the index can really go towards its all-time high or not. And that all-time high for the Nasdaq index is right over here. Obviously, this is the most strongest index among the other two US indices, which are S&P and the Dow Jones Index. So for us, the opportunity in terms of the upside is right over here. If that doesn't work, then the 50-day moving average can certainly work, right? Now, guys, this is over to you guys, over to you folks now. This is your opportunity to ask questions. Okay, so questions are why two lines for support and resistances? Because this gives us not one, if you draw just one support line, then it is very difficult for you guys to wait for the price to come into that area. When we draw some area of support, like how I've done, like I have the bottom of this particular candle and I've encompassed some of the consolidation of these three candles. This gives us a better chances for the price to come into this area of support. So the moment that the price comes into this area of support, that could be an opportunity. So rather than just waiting for that one particular point, for example, if you just wait, if your support line is at 10, price may never come to 10, price may just come to 960, 980, But if your support area runs between $9 to $10, you are likely to get that support zone. You're likely to get back into that trade. The same concept for resistance. Simple moving averages. The question was whether I prefer exponential or simple. Because I trade mostly on a longer term, so it's simple moving averages. Okay, so the most traded index is obviously the S&P 500 index, SPDR index, SPY, it is that. And then, of course, after that, it is your QQQ, that is another ETF for the NASDAQ. So for the other, for a normal, for a simpler answer, there are three indices. They're both all of them are very important. S&P, Dow Jones, and Nasdaq. People usually would trade, at Nasdaq for tech purposes and Dow Jones for the top 30 stocks. Okay, I'm not sure which DAX indicator. I think if you look at my previous tweets that I have replied to people, I have certainly given those indicators for the DAX, for the one that we talked about previously. Yes, this platform is available. MT4 platform is available on Trade. Do you use Fibonacci? I only use Fibonacci for retracement purposes. Like for instance, when the market was dropping, like for example, in the S&P 500 case when we were trading in around here, I was measuring the Fibonacci ratio that how much retracement we have done. If the price goes above the 50%, the chances are that the dead cat bounce is not likely from that point. I think DAX index is again going to follow for other indices as well, but I'm more focused on the US indices. And if they are if they continue their journey to the downside, obviously the European indices will do as well. Because European indices are far, far, far more weaker than the US indices. Okay, guys. I suppose this is where we end. I have gone through most of your questions, but for any other questions, please feel free to come back to me on Twitter. You already have those details, and I will flash them once again for you guys, just in case if you do not know. And remember, as always, the recording will be available on our YouTube channel. And then you can always go back and then get those levels whenever you want to. And this is this is the detail for our Twitter accounts. Hi, folks. Thanks ever so much, and thank you for coming, and thank you for your time for attending this webinar as always.